Okay. Um, Good day, everyone, and welcome to another edition of Strategic Financial Management. In today's class, we shall be talking about the risk-adjusted cost of capital or project-specific cost of capital or an appropriate cost of capital. Some will say it is called beta factor class. Some will say it is called what? Beta factor. Beta factor is still risk class. Some will say, oh, this topic is beta factor. Beta factor is risk. And we are talking about risk adjusted cost of capital. It could be in your exam, you could see that, oh, calculate risk adjusted cost of capital, project specific cost of capital, or appropriate cost of capital. Now, question will not tell you that you should calculate beta factor. No, that is why I say some people will say it is beta factor. Beta factor is risk. So which means that it can be any of these three. Either the risk adjusted cost of capital or appropriate cost of capital or project specific cost of capital. The question is that what did they use this for? Class. Let's look at the vertical illustration. Risk adjusted cost of capital or project specific cost of capital is used when a company want to diversify. Class. When a company is producing bread, then you want to go into the production of cement. You can see that there are two different industries. Now, for you to discount your project, for you to discount that project, that new project that you are diversifying into, it's not that you are leaving that, you may decide to leave and move to the other. You may decide to stay with bread as well as stay with cement, right? For you to calculate the discount factor that you will use to discount the project, right? You need to consider some risk in that what? In that cement industry. Now, that will take us to capital budget because you will do a capital budget whereby you will use an appropriate cost of capital to discount the project. It depends if the company is diversifying. We will get there. Now, this means that your risk adjusted cost of capital, you need to include the risk involved in the cement industry. You are producing bread, right? Right? Raula is producing bread and Raula want to go into the production of cement, right? Now, for you to get the DCF that you will use because you want to know if the project is viable or not, for you to know the DCF that you will use to discount that project, you need to consider the risk involved in the what? In the what? In the cement industry. That is why it is called risk adjusted. You need to adjust, you need to include the risk, right? Not just calculate cost of capital and use it. No, you need to consider the risk in the cement industry, right? And that is what bring about a beta factor or risk adjusted cost of capital. Or when you see a question whereby they say, oh, we are into this production, packaging, and we want to go into food industry. You can see that there are two different things. So now, for Raula to diversify into the production of cement, Raula need to identify some people or some companies who has been in that cement industry, right? So that he can identify the risk involved in that what? Cement industry. We will get there. So now, class, do we have an understanding of this topic, right? The definition. Are we good? Are we good? Class. Okay. Now, if that is established, class, if that is established, don't forget this. When you see a question, they say risk adjusted or specific, it means that in that question, don't forget that you need to read the required first. Don't forget that in that question, definitely the company is diversifying. There is a diversification. Just see, once you just read the required, they say risk adjusted cost of capital. Just pick it. Oh, this company is diversifying. Just pick it. Then the next thing to come to your mind will get there, right? Now, another thing you need to know is what is asset beta? Class, please confirm if you can see my screen. Can you see my screen? Okay.
Yes,
Yes.
sir.
Okay, good. Now, asset beta. Class, what is asset beta? Asset beta measures asset beta measures systematic business risk. Class, don't forget that we have defined systematic risk as a risk that affects the general business environment, right? You talk about inflation, exchange rates, unemployment rate are systematic risk. So asset beta measures systematic business risk. So definitely when they talk about business risk, you talk about systematic risk. Systematic business risk. Class, take note. Asset beta measures systematic business risk. Right? Now, if that is established, you need to understand what is equity beta, because when you are diversifying, class, what bring about asset beta and equity beta? When you are diversifying, you need to understand the business risk. Raola need to understand the business risk in that cement industry. What are the business risk? Although when you're talking about systematic, it is generally that will affect everybody, right? Right? Now, look at what is happening take a look at what is happening in in what is it called? Oh, in banking industry. The CBN capitalization, you can see the risk. It is only affecting them. They should go and look for so billion. Without that, or not before so date, right? Now, equity beta. Now, we have defined asset beta, right? Because when you want to diversify, we will get there. Now, equity beta. What is equity beta? Now, if asset beta measures business risk, systematic business risk, right? Now, equity beta, we measures measures financial risk. Class class if okay, let's put it in two ways. Asset beta, let me scroll down so you see something coming. Okay, equity beta. Okay, that's coming. Just a minute. Okay, equity beta. Okay, now we are in equity beta. Equity beta measures business risk as well as the financial risk. Class, asset beta measures just systematic business risk, and we have stated an example of that. Now, why equity beta measures both the business systematic business risk as well as what financial risk. Class, it measures the two ways, which is the systematic business risk, right? Which is the equity beta, right? And what the financial risk. Class, what does this mean? Raola is diversifying, is producing bread, right? And he wants to diversify into the production of cement. Raola will consider the business risk that is affecting everybody. That is systematic business risk, right? One, Raola will now say, we now add its own, definitely financial risk. There are some risks that will be affecting what is it called, Raola, which is financial risk. So the combination of the business systematic risk where you are going to and the financial risk of Raola the two together, the two risks together will result to the two risks will result to what? Equity better, right? While assets better measures systematic business risk, right? While equity better measures the financial risk of Raola and the business risk of the cement industry. You can see that when you add the two together, it becomes what? An equity better, right? And that is the definition of asset better as well as equity better. Now, when a question now comes that, oh, calculate the project specific cost of capital or specific cost of capital or appropriate cost of capital, what are the steps? There are 5 steps you need to know. Now, you see these 5 steps, right? Even when you are sleeping in the midnight, remember these 5 steps. Just like how to determine weighted average cost of capital. Even in the middle, even when you are going to work, be saying it, or you listening to the videos, right? On that. Now, what are the procedures? Don't forget that once you read the required, and the required says calculate the project specific cost of capital or appropriate cost of capital, one thing should come to your mind. What is it? That the company is diversifying, but you don't know because you've not read the question. Then the second thing that should come to your mind is that what are the steps you will use in calculating the appropriate cost of capital or the project specific cost of capital or the risk adjusted cost of capital? What are the procedures? One, identify the proxy company. Now the question is, what is the company, a proxy company? They call it surrogates, right? surrogat company or proxy company. Now a proxy company is a company that the Raola is diversifying into cement. Raola need to identify cement company, right? You need to identify some cement company so that you will know the business risk in that what? Industry. That company that you are identifying, it is called a proxy company. It is called what? Proxy what? Proxy company. Class. Raola is into the production of cement, of bread production. Raola wants to diversify into the production of cement. Raola needs to identify a company that is producing cement so that you will identify the business risk in that world, in that industry, right? Now, with that company that you identify, right, that other company that you identify is called what? A proxy company, or surrogate what? Company. Now, once you read the question, you have identified that company. The second step is for you to de-gear or ungear, right? De-gear or ungear by removing the financial risk of the proxy company. Of course, you need to remove the financial risk. Financial risk is the risk that is affecting that business. It is just affecting that company. It is not affecting everybody generally, because the risk that is affecting someone who is producing bread will be different. Financial risk that is affecting someone that is producing bread will be different from the person that is producing cement. Now, financial risk, maybe the financial risk, inability to pay loan as and when due. Let's say they have bad debts, then they were not able to meet up with their long-term obligation, is a financial risk. It is only affecting you. It is only affecting you. So that is why they say you have to remove the financial risk of that cement that you identify. Remove it. We don't need it because that risk only affects you. It does not affect everybody. So when you remove the financial risk, it will now remain the what? Asset better. That is calculate asset better. Don't forget the definition of asset better. The business risk. business risk, asset beta. So you will now left with what? Business risk. So asset beta. So you've removed the financial risk of the proxy company and you now left with what? Business risk. That is, calculate asset what? Asset beta. So this asset beta that you want to calculate is for the proxy company. Don't forget, it's for the proxy company. But you want to remove the financial risk because you are not interested in the financial risk. Because that financial risk, let me now give you another practical illustration. You have you have next gen professional associates now in Abuja. Then you have another tuition center in Lagos, right? The financial risk that is affecting us is different from what is affecting them, right? So you remove it because you don't need what is affecting them. You only need the business risk that is affecting the same industry, that is affecting them, that is affecting everybody, right? That is what you need. That is why they say that is calculate what? Asset beta. So the formula to calculate asset beta is being shown on my screen that BE, you will see the definition where I define the BE, VE plus and all that. And this is the formula, right? Now, class, the BE represents the equity beta of the proxy company. The company you are diversifying into will be given to you in the question. VE is the market value of equity. Market value of equity may not be given to you in the question. They may give you the current market value price. They may give you the current market price of 2 naira per shares. Class, you already know that when they tell you that the current market price is 2 naira per shares, what do? You multiply by the numbers of shares to get the market value of what? Equity. So value of equity, right? Market value of equity, which is VE, VE plus VD. VD means by market value of debt. Of course, they will give you the market value of debt, maybe 2 naira per bond, for instance, 2 naira per bond, right? So 2 naira times or 2 naira per bond, 2 naira times the numbers of bond will give you the total market value of debt for what? For debt, right? Plus BD. BD means better debt. BD means what? Better what? Better debt, right? Plus VD. VD means value of debt, 1 minus tax rate. The tax rate is for the proxy what? For the proxy company divided by VE plus VD. You must memorize this formula. You must know it. You must memorize it, class. Now, note in a question when BD is not given, when BD, you can see it there, when BD, excuse me, when this, okay. So when the BD, you can see the BD here, when this BD, right? When this is not given to you in the question, what will you do? So which means that BD will be equals to 0. So definitely automatically all the information from that BD times VD will be equals to 0 because if BD is 0, everybody, all the elements in that left hand side, everything will be 0. So therefore, your equity beta will be equals to BE times VE. You can see BE times VE divided by VE plus VD 1 minus, because all other side will be automatically becomes 0 when beta debt of the proxy company is not given in the question. That is equals to 0, right? Now, if the second steps is established, we will move on to the third steps. Regear by including the financial risk of the main company. Class, you can see the second step says that you should remove the financial risk of the proxy company, of the company you are diversifying into. So when you remove financial risk, you have business risk that is affecting that what? Business. Now, when you remove it, when you have that business risk, is that also? Now, you will not do what? You will now regear me by including the financial risk of the main company. The main company is the bread industry, right? Manufacturing industry that is producing what? Bread. You need to include the financial risk that is affecting Raula Bread PLC. Then add the business risk of the company you are diversifying into. The addition of the two is what we call equity beta. Class, do you understand the gist? You have to remove the financial risk in the second step. When you remove financial risk, you have the business risk of that company that you are diversifying, of that industry that you are diversifying into. Now, when you now include the financial risk of the main company, so which means that now that is producing bread, oh, the financial risk that is affecting them, maybe inability to meet up short-term obligation or long-term obligation is there. Then you now include business risk of that company you are diversifying, of that industry that you are diversifying into, right? Because you need to consider the risk in that what industry, right? Now, so with that, you calculate your what? Your equity beta. So therefore, equity beta is calculated as, equity beta is calculated as what? BE. Where is it? Okay. Now you can see the equity beta, right? Equals to, that is why they say equity beta measured financial risk and business risk, right? Because it includes both financial risk of the main company and the business risk of that industry that you are what? That you are diversifying into. Class. Now, class, when your BA that you get here, when you get your BA in this part, then you bring the BA to this place because that is your business risk. BA, right? You put the BA class, you put the BA. Now, your BD, which is the better debt class, this format, this formula here, from the BD, from the better debt to from the better debt, I'm coming, from the better debt to VD, from that better debt, coming, I think it's not showing now. Okay, from that better debt to VD, 1 minus T equals divided by VE. You can see the BA is the business risk of the proxy company. Now, from that BD, VD, 1 minus T divided by VE, that side is the financial risk of the main company. So, which means that the better debt will be for the main company, the value of debt, market value of debt will be for the main company, the tax will be for the main company, the divided by VE will be for the main, because you are adding the financial risk of the main company to the business risk. What is the business risk here is your BA plus open bracket BA is the business risk. Then you will now add the financial risk of the main company. So the financial risk of the main company starts from class, so start from BD. So better debt of the main company, value of debt of the main company divided by VE, market value of debt of the main company, tax rate class of the main company. Now, if better debt of the main company is not given, it becomes what? Zero. It becomes what? Zero, and what? And you move on with that class. Are we still together? Please, I need to confirm that. Are we still together?
Yes, sir.
Yes, sir. Well, too.
Okay, okay. Please take note of that side. It's very important, right? It's very important. From that better debt to VD is for okay, we are not together. Okay, okay. From that better debt, from that better debt, step 2 is confusing. Okay, we'll come back. So from that better debt, seems you are just joining, right? From that better debt, VD, 1 minus tax rate divided by VE is for the main company, is the financial risk. All the, you don't check, is better debt of the main company given to you in the question? If it is not given, zero. Value of debt, market value of debt of the main company, you will see it there in the question. Then VE is the market value of equity, is there, will be given to you. The T, which is the tax rate of the main company. So that is the financial risk. That is why they say you give by including the financial risk of the main. So that all that part is the financial risk. You see, your BD is your business risk of the proxy company. So you are including it together. That makes your what? Your equity what? Equity better, right? Now, before we go to step 4, um, uh, Samuel,
Yes,
before we
sir.
move to
Good afternoon, sir.
okay, good afternoon.
Yes, sir. Okay, I have a question. Okay, for the step one that you said for the to remove the financial risk, are we talking about ungearing the financial risks of the project company?
What is this?
Sir, do you understand my question?
Samuel,
Yes, sir.
what is this?
Okay, on
Read it.
I didn't see it now, I just saw it now. Okay. It's fine now. Thank you.
See, leave all those English. Leave all those grammar. Hmm? Me, I'm not even interested in all those gear or on gear. I'm interested in the steps. Do you understand the steps? See, just understand that you are removing the gear or en gear means you are removing something. You are remove it, remove it. You are removing the financial risk of the proxy company, right?
Yes.
That is calculate what asset beta. So in this step two, Linda, let me come in. This steps two means that you should calculate asset beta. Asset beta measure business risk. That is why they say by removing you remove the financial risk of the proxy company. What is proxy company? Is the company you are diversifying into. You don't need their financial risk that affects them only, because the financial risk that is affecting next gen professional associate is different from the one that is affecting another tuition center. So you don't need their financial risk. Is that also the only thing that you need is the business risk that is affecting the industry. So that is why you say you remove the financial risk. So when you remove the financial risk of the proxy company, the what you will left with is the business risk only, right? Then all this information, BE, VE, VED, are all for the what? For the business what? Risk. That is the formula. But when BD is not given to you in the question, when BD is not, which is the better debt of the proxy company, automatically what is on your left hand side will become zero. So that is why I say note when BD equals to zero. That is when it is not given to you in the question. You just maintain your the one of your okay right hand, this is right, okay, the one of your right hand side. If your BD that is on the right hand side is not given to you, it becomes what? Zero. Then the one you make use of the one of your what? Left hand side. Don't forget all those information are for the proxy company, which may be given to you, which will be given to you in the question. It's just for you to identify them. Linda, are we good? Are we good? Please unmute your mic. I
Hello,
can't hear
Ibrahim.
you. Yeah, I'm with you.
Hello, please.
Okay,
Can I ask
we
a
are good.
question?
Please go ahead.
Yeah, sorry for this. Step three. This BE calculating BE. So can it be done this way? Like after calculating
I can't hear you, exclusive. It's because you are eating and you did not call us. That's why the
BE.
network decided to do you shege.
Hello,
It's because you are
hello,
eating and you didn't call us.
hello,
That's why the network is doing like this.
hello. No, no.
You are eating and you didn't call us. Okay, go ahead. Okay. I can't hear you. Maybe you log in, log out and log in. I can't hear you.
Better food in the chop.
Abi now, you show. No, no, leave man. Exclusive.
Hello.
Yeah, I can hear you
Ah,
now.
network. Hey, Jesus.
I know when you know eat alone. When you are
Okay.
eating and you didn't call us, did you call us?
No, 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 no be chop. No, 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 no be eat.
Mm.
No be it. No be it. I
Yeah,
see. My
nah,
question is for this regearing for this step three. Can you hear me now?
Mm-hmm.
Hello. Can you hear
I
me?
can hear you. Go ahead. Yes,
Okay. I said
go
sorry for
ahead.
this step three. So is it possible to just do a change of subject formula when we get the BA? Just do a minus and then after
No,
getting the BA, just
no.
do a minus.
See, yes, there are situations like that. There are situations like that, of which I think. Okay, chief will take that part when he's taking capital budget. Yeah, to take that part. So now, sometimes you don't need to calculate BA. Sometimes in a question, the BA is the business risk, right? Is the asset beta of the proxy company, right? Which is the BA. You may not need to calculate it. It may be given to you in the question. So definitely you've already skipped step 2. Then you put your BA minus BD, VD minus. But at times as well, your BE may be given, but most times question will not come that way. There's a way the question will come, right? We'll get there. I think if we do that one part, yeah. So we'll
Okay,
get
no
there
problem.
actually. Do you get? So
Thank
you
you.
can't skip any step. Unless if that one is given to you in the question, right? That is when you can say, oh, you want to skip this step because it is given to you in the question. Class, can we move on now? Can we move on? Are we good?
Yes, sir. Let's move on, sir.
Okay. Let me take my water since exclusive did not call me. So let me just drink one water.
No, no, no. I know they chop now. I wasn't.
So next is you calculate the cost of equity using the what? The capital asset pricing model. Now, class, using the what? The capital asset pricing model, right? Now, your BE, that is why, don't forget, there is one question that we solve that I think Eco PLC, I think the second requirement B, requirement B says that explain the process of using the capital asset pricing model to determine the appropriate cost of what? To determine the appropriate cost of what? Appropriate cost of capital. And these are the process that question is talking about. Now, when you get your BE, you use it, which is your equity beta, you use it to calculate your capital asset pricing model. You can see KE equals to risk-free plus equity beta that you calculate, market return minus risk-free. If there is premium, you know how to do premium. It will be risk-free plus equity beta, open bracket, risk premium, right? Now you can see that your equity beta, your cost of equity using CAPM has include the business risk, right? As well as what? The financial risk of of both the financial risk of the main company and the business risk of that company you are diversifying into. You can see it now. So that is the process. Definitely, you need to use that to discount your project. Why? Because it has already contains the risk in that industry that you are diversifying. Because when you just use ordinary cost of capital, equity, or weighted average cost of capital without including the risk in that industry, right? You could undervalue, the project are supposed to be positive, right? You may end up having the project are supposed to be negative, it may be positive. Then you will now look at it, hey, this project is viable because you did not consider the risk of the industry, right? And that this is the process. When you want to calculate the cost of equity, right? And they say, oh, explain the process of capital asset pricing model, how it is being used to calculate the appropriate cost of capital. You can see how it is being used to calculate the appropriate cost of capital from the asset beta to equity beta, asset beta and equity beta. From your equity beta that include the financial risk and the business risk, you can see, which means that your CAPM has already included, right? Your explanation there should be based on the business risk and as well as financial risk, and you give them the formula that, oh, the capital asset pricing model as an inclusive of the business risk of this social company that they are diversifying into, as well as the what? As well as the financial risk. You can now define the business risk and financial risk, put the formula, and you move on. That shows that you know what you are doing, right? And that is it. Now, if that is established, calculate weighted average cost of capital. I know most of you will ask question that, hey, where is our hash total? I know most of you will ask hash question, where is our hash total? I purposely hide this formula. Yeah, I hide it. I don't want to bring it out when we are doing the normal cost of capital without risk. I purposely hide this formula. Yes, get used to that part, right? So either of the two, right, is applicable. You can see the weighted cost of capital, the market value of equity times the cost of equity divided by the value of equity plus the value of debt. Of all these are for the main company. The final one are for, because you want to calculate for the company. Everything, the market value of equity that you use be for the main company. The cost of equity that you calculate, of course, you already calculate your cost of equity, which is your CAPM. You can see, because your CAPM has already include the risk of the business, both the business risk and the financial risk, plus the value of debt of the main company, plus the KD. KD means cost of debt. If in the question they tell you that pre-tax cost of debt is 10%, what it means is that there is no tax relief. They've not considered tax. For you to consider the tax, you need to do KD 1 minus tax rate, that is after tax. Don't forget that all what we have been doing, even if you want to use hash total, all what we have been doing, we have considered tax effects. Don't forget, we have considered tax effects under the cost of what? Under the cost of debt, because we say interest 1 minus tax rate. Is that not so? Interest 1 minus tax rate. We have already considered what? The tax, right? So in a question, now, they say, oh, the cost of debt or pre-tax, you have a pre-tax cost of debt. Pre-tax cost of debt means there is no tax relief yet. So you need to consider the tax relief, and you say, oh, cost of debt 1 minus the tax rate of the main company. But if they say it is after tax, right? If they say it is after tax, you move on and you say you will not use 1 minus tax rate again, because tax has already been what? Be considered, right? And you do it, you get your weighted average cost of what? Capital, or you use the one of what? Hash total, any one of the two. Now, let me quickly, another thing here, under the risk adjusted cost of capital is another thing here, under the risk of the main problem, another problem under the risk cost of capital is, for instance, class, if debt to equity is given as, this is the level of gearing, right? Debt to equity is given as equals to 10%. Who can tell me what is the value of debt? Yeah. And what is the value of equity? Who can try? Value of equity. If debt to equity ratio, which is the level of gearing, is debt to equity ratio is 10%. So what will be the debt and what will be the value of debt? What will be the value of debt and what will be the value of equity? Sometimes your value of debt may be expressed in percentage, may be expressed in what? In value. It depends on what it will be, even be shown. They will tell you that, oh, the market value of debt or the debt to equity ratio is 10%. Okay, exclusive.
Yeah, sorry. This thing is a bit confusing, but me normally I'll use 90% for VD because the total should be 100. So
Interesting.
yeah.
Okay, so debt to equity, you will use 90 for what? Which one will
For
you use
VD,
90 for?
value of debt.
Okay, you use 90 for debt, then
Yes.
you use 10 for equity.
Yeah.
Interesting.
But
Interesting. So
it could be dicey.
interesting. Okay, well, I'm coming, Rachel. Rachel. Rachel, she has been consistent in our class, as well as exclusive, comfort. I salute to every one of you. Well done. So, Samuel, let me call Samuel before I come back to Rachel.
Okay,
Samuel
sir. Since it's debt to equity, I think the value of debt is 10% and equity is 90.
is 90.
Yes, that is
Oh, debt is,
equity is
okay,
90,
debt is,
debt is 10.
Yeah.
okay, okay.
Sorry.
So
Yeah, sorry.
equity is 90. So interesting.
Yeah,
Interesting. Equity is 90,
yeah,
debt is
yeah,
10.
yes.
Interesting. Okay, Rachel.
Okay, sir. The normal ratio is 60/40.
This your bedroom voice. I beg now.
Yes, sir. I feel the normal ratio is 60/40. For equity should be 60 and debt
So I can't hear you. I said I can't hear you.
okay, I said
Come again.
normal ratio should be 60/40. Equity that is 60 and for debt 40%.
Interesting. Interesting. Okay. Oh. Hmm. See, there is not like normal ratio is this. So okay, I'm coming. Samson. There is nothing like normal ratio. There is nothing like that. Oh. It depends on what is given to you in the question,
Okay.
Rachel. Uh-huh, uh-huh. It depends. Debt to equity ratio. Debt over equity. They can tell you debt to assets. We'll come there. So now, debt to equity, right? Let me check the charts. Okay, I didn't see anything here. Someone said, okay, value of debt is 100. Then market value of equity is 10. Interesting. Now, when you see a question like this and your level of gearing, you want to know the market value of equity as well as your debt, right? What you need to do is that since they give you wow, so since they give you 10%, so it means that the 10 is the market value of debt class. It means that debt to equity, debt comes first before the equity, right? Now, it means that the value of debt is 10, while the value of what? Equity is what? Is 100. So it must be like your denominator should be equals to what? 100. Please take note. Question may come different form, right? I will still show you another form. If you have debt to equity, your value of debt is 10. Your value of debt is 10, while your value of equity is what? While your value of equity is 100. Okay?
Yeah, please bear in mind, this particular thing is a bit somehow because in some instances you see some people, some text or some material they will do 10 and 90, and in some instance again you see 10 and 100, because I've not really gotten any serious justification for the is there a way to look at it critically and say, okay, this is actually 100 for equity and 10 for debt? Because there are, it's always, let me say, it's a bit confusing in some text, you know. Yes.
Okay. Okay. For those who marry textbook, okay. Well done. So now in another part, I will give justification to that. Don't worry. She is that okay. This is 10, right? So this will be 10. I'm coming. Why this will be 100, right? Now, in all those tests you are seeing that they will give it 10, 90, 10, right? Now, this is the situation. When you have debt, this is the situation. Debt divided by debt plus equity. This is the situation whereby you will have such things. If you have, and they say your debt to your equity, your debt is equals to, they give you the function that, oh, the market value of the debt and equity is debt divided by debt plus equity is equals to what? Is equals to 10%. Is equals to what? 10%. So now, what is your value of debt and what is your value of equity? Class, what is your value of debt and what is your value of equity? Now, in that case, that your instance will now comes to, that is why I say, even when you are reading textbook, you should be very careful, because textbook will not tell you that, or when they give you this. And that is what we are doing at NetGen Professional Associate, right? When I was telling the performance management students yesterday that imagine you know NetGen last diet, imagine this question could have been a bonus question for you, right? Now, in a situation whereby you have debt to debt plus equity, debt over debt, it is your level of gearing. You are talking about your debt. You finance it by debt as well as equity. Your denominator should be equals to 100. Now, your value of debt here will be 10. Your value of debt here in this situation now, you can now say what you just said just now. Your value of debt will be 10. Your value of debt will be what? Will be 10, right? Then your value of equity will be what? 90. You can see that when you look at it now, you can have 10 divided by 10 plus what? Plus what? Plus 90. You can see that your the numerator is equals to 100. And that is the situation whereby you will have such scenario. Exclusive. That is the situation whereby what? You will have what? Such scenario. When your level of gearing means that your debt, both your equity as well as your debt, right? Now, when you see debt to equity, when you see debt divided by debt to equity, which means that business is being financed by equity and debt. Don't forget that when your level of gearing is above 50%, there is an indication to that. When it is below 50%, there is an indication to that. When we get to financial analysis, in case study, we'll talk more on that. Now, the value debt is equals to what? 10. It will be 10, right? Your debt is 10 plus your what? Plus your equity. Please take note of this case scenario. Now, let me now give you another worst case scenario in some question. Let me give you another case again in some question. They may not even give you 10%. It may not be 10%. They may not say 10%. It could be 0.1. And when they say 0.1, you should know what it means. Just multiply it by 100 so that you don't confuse yourself. Who is that?
Oh,
Who is
sorry.
that? So that you will not do what? You will not what? You will not confuse your what? You will not, please mute your mic. Thank you. So that you will not do what? You will not confuse yourself. Just multiply it. Whatever percentage they give you, maybe 0.1 or 0.2, just multiply it by 100 so that you get your percentage. Now, another worst case scenario. Okay, exclusive. Do you have a question? Okay, it's fine. It's fine. Exclusive.
Yeah, sorry, I just wanted to
Okay.
say, okay, if we can simulate another scenario, let's say debt to equity ratio is 30% or 25%.
Okay. This call will end in 4 minutes. Okay, let me quickly do that so we can create another link. Okay, let me just change this. Okay, is to 30%. Let me create another. There's another last scenario that I want to create. Maybe when I create a new link, I'll do that. I'll do that. But all these notes will be sent to you. If you pay for the material, I'll forward it to you immediately after the class. So this is how many percent? This is 10%, 30, let's say 30%, right? So what it means is that your value of debt is equals to 30, right? Your value of equity is what? Is 70. Don't know so? Is equal to 70, right? That is 70, right? So what it means is that when you look at this now, so you could have value of debt to be 30 divided by 30 plus 70, right? And that is it, class. And that is it. So I will give you the last worst case scenario whereby that one is, they will tell you that debt to assets, right? So why I have all these case scenarios is because, like I said, before we start SFM, I have over 1,000 questions, both in AFM, financial management, as well as SF, everything. Why? Because I've looked at so many questions, I've saw so many questions, different case scenario, and you can as well do that, right? By solving a single question that you solve does not prove, right? Does not show that you already understand that particular topic. If you don't solve at least 2 to 3 questions, then you're now like, oh, the question can come this way. That is why we are trying to analyze each of our questions. That don't forget, question can come this way, can come this way, whichever way that comes. So you get yourself or prepare for it, class. So, and that's all about this. So I'll create the new link so that we can continue from where